Really what you need to keep in mind is big down payments, some form of credit check, high interest rate, and as short a term as possible.
Like if you are moving a deal, buying for 70 cents on the dollar and moving it in a week versus buying for 50 cents on the dollar and moving in a year, like your return on that first option is much, much better because how fast you're turning your money.
You don't know this, but probably the number one best investor that I work with, the guy that I have the most respect for, he is just an absolute monster in the industry, came up through your program.
Hey everybody, welcome back to the Real Estate Investment Podcast. I'm your host, Ron Apke, joined today by Eric Scharaga. Eric's a huge funder in the industry for land deals. He does a ton of land notes, been doing land notes since 2017. Eric, welcome to the show.
Ron, great to be with you. Thank you very much.
And this is part two. I mean, we'll touch on a lot of the stuff that we talked about a few years ago. A lot's changed, I'm sure, that we can talk about. But if you guys haven't watched the first one, probably watch this first and go back to the first one. But Eric is a wealth of knowledge in the financing space, everything like that. A lot of people, Eric, are talking about like seller financing. I think that's a big thing because you get so many people and you hear passive income, passive income, passive income. So many people like come into real estate, and that's what they view real estate as. If it's rental properties or land notes or anything like that, is passive. They talk about seller financing. Is that note space growing in land investing? Or first, you want to kind of define what seller financing is in your mind, what that kind of looks like, and then we can talk about kind of what the industry looks like right now.
Great. So seller financing, in my mind, as it pertains to land, is offering another option to your buyers besides just a cash sale. It provides flexibility and it provides an opening to an entire new buyer pool. So if you want to sell land faster and for more money, you really should be considering seller financing, because in this current market, you really will sell your land probably 3 to 5 times faster if you're considering that financing. And you're essentially just acting as the bank. So you own this property and you're providing the terms to the buyer. So you are taking some cash at closing, typically 20% or more, and you're providing terms and you're providing the loan to the end buyer, which is really a win for all parties. And then a lot of people either at closing or after closing explore the sale of the loan, because depending on what business that you're in, it might make more sense or less sense to keep the note or sell the note, because land investors, their primary business is flipping land, and that's where they make the majority of their money. Whereas my business is different. I don't run a land business. I run essentially kind of a debt business. So my goal is to obtain those loans, and I make my income from the principal and interest payments.
Yeah. So I guess you have two kind of sets of people. You have people that are trying to like flip land, make cash. And then you also have people who might be coming in this business. Like, I want to build up a note business and have $15,000 every month coming in. I guess those are kind of clear avenues. And so one party is trying to essentially, let's talk about the people that are selling notes, because that's people who more so relate to us, or kind of people that are following us, are people who want cash. Like, they want cash so they can put it into marketing, put it into the next deal, grow their business, opposed to like having all their money out and then slowly getting money coming in. So if someone has never offered seller financing, so essentially you want cash, but okay, here's another avenue essentially where you can still end up getting cash. So what does that look like? What's different from their end that they're doing if they want to potentially get seller financing buyers but still sell the note?
Yeah, so what I would recommend is probably working with someone directly who can help you both market the property and then help you through the closing in terms of providing the necessary paperwork so that you are selling the loan at closing and you can capitalize at closing. What I recommend is the note buyer is going to want to purchase the loan at discount. The way to get around that is to have a different price for your cash sales as your financed sales, because people typically, in my experience, are willing to pay about 10% more for the luxury of seller financing. The other things that I would recommend, there's really what you need to keep in mind is big down payments that's really your security, some form of credit check, high interest rate, but not too high. I think 11% is good, and as short a term as possible because we are not Fannie Mae and we're not in the business of providing 30-year financing for
Yeah.
people because the longer the term, the higher the risk of default.
So let's break down a deal, for example. Let's say someone has a right now, someone listening has $100,000 piece of land that they have posted. It's sat on the market for 3 weeks. They still think they should be able to get $100,000. What should let's kind of break down what that looks like when they offer seller financing. What should they be doing? They have all these listings out posted for $100,000, MLS, land.com, all these different places. What should their next steps be to offer seller financing?
Yeah. So what I recommend is that you put in your listings that seller financing is available, but do not put any of the terms in the listing because not everyone will qualify for the terms that you advertise, and you don't want to post any type of discriminatory ad. So just keep it very general that you're offering seller financing and people will call in. When they call in, I recommend that you ask them 2 questions. The first one is, do you have 20% down? If they don't, in my opinion, they can't afford it and they probably shouldn't be buying it. If they do, great. Your second question is, how's your credit? Depending on the answer that you get, you will know essentially by reading between the lines how their credit is. Some people will say, well, that's none of your business. Some people will say, I have no idea. Some people will say, oh, it's good. This is my credit score. And really the way that I recommend that when you get to that point, Credit Karma is a great way to very easily gauge someone's likely credit score. It's just fast and easy, and that's something that they can screenshot and share with you in lieu of doing like a formal credit check. It's not perfect, but it'll give you a good indication.
So they will be trying to sell for like $110,000 theoretically with this. Let's say they find someone. What credit score are they looking for first off?
My cutoff for 20% down is 690, just because these are typically non-owner occupied sales. And so we want to make sure that this is an end buyer who can both afford it and has a proven track record of paying their bills on time. But in my experience, the two probably even more important than the credit score is the down payment. People don't walk away, in my experience, from large down payments.
That makes sense. So listed for 110. Okay, we got someone with the credit. That makes sense. Okay, someone's credit 700 credit. Awesome. $22,000 down. They have. Okay, so someone comes to you in that situation. They get this person. Are they getting this person under contract with these? Or are they like, okay, I know I don't want to hold this loan. So your options. I guess we would be talking about interest. Let's get interest first. What interest are we talking about them, or should they not be talking about interest with them yet?
I recommend that once they answer the 2 questions
Yeah.
and you move on to negotiations about the property, you're going to need to settle the purchase price, 10% over your cash price, amount down 20% or more if they offer more. Term, I think 8 years, 10 years, that's really the sweet spot. And then interest rate, my standard is 10.9, so right around 11%. Some people do 12%.
All right. So then they're coming to you. Do they get this under contract if they have the idea of selling a note on the back end? Should they be getting this under contract, all these terms that we just talked about under contract, and then kind of reaching out to someone, be like, I have this buyer. Is that correct?
Yeah, that's exactly the way it works. So typically under my note buying program, they would do the initial negotiations, and then I would do the credit check, and then I would get back to them with what I call a term sheet. It
Mhm.
has all of the terms of both the seller finance sale and the amount that I'm going to end up paying for the loan. And then they will just attach the first portion to their contract. They'll submit it to title, and then I will be there to help them through the process
Got
of
it.
getting the deal closed. I kind of know how to deal with the title company, so I'm there to advise them on that.
So in this situation, $110,000 is what we agreed to on the term. 22,000 down, so the loan is $88,000. What is this land investor gonna see once you buy the note?
Yeah, 80 to 90% of the sale price.
Okay, of the sale
So if
price.
they're
So
at
that's
110, if they're at 110, selling at 110, they are going to net the same amount as if they sold for cash at a 10% discount.
so like
So
90.
whether you sell at 110,000 and receive 80 to 90% at closing of your sales price, that's going to be the same as if you sell for 100,000 cash and someone comes in with a $90,000 cash offer and you take it. The only difference is that you're going to be selling the property probably 3 to 5 times faster if you offer the financing.
Yeah. Are people doing this in faster markets, or is it like I think having more options when you're in a slower turning market typically is always valuable, and you have people. I mean, you just got to obviously make sure you have a qualified person to hold the or to be able to sell the note. But what markets are people? Or are you just having people like offer this all the time? Because I mean, a lot of people don't want to lose $10,000 just to lose. But if you could sell it, that's if you could sell it for $100,000 cash or $100,000 on a bank loan. But realistically, if you're struggling to sell something, like this needs to be an option. Are you seeing this in fast markets, slow markets? It doesn't matter.
Really, all markets. Most of the people that I work with are offering this financing on every deal. Where I really think it works well is more expensive properties, 150,000, 100,000, because those people don't necessarily have the cash, but they do have the 20% down and they're willing to make the payments. So that's really where it works well. But it's really universal, and I would argue that whether you sell the note at closing with financing or whether you sell for cash at a discount, you're really going to end up with the same net amount
Hmm.
at the end.
Yeah, that's a good point. And is there push? I mean, I'm sure there's some pushback at times, like raising the price to $110,000 for these, but I assume it's pretty understandable. How often are they getting pushback? Is that pretty like standard in terms of being able to sell over asking price when it's a seller financing?
Yes. So, in my opinion and experience, seller finance, seller financing is so rare and such a luxury that people are willing to pay 10% more
Mm.
for the ability to make the payments over time.
And that's not like a standard thing, guys. Also, like if you want to try to go for 15%, like if you think you can get 15% and make it $115,000 loan, I'm sure Eric would still be interested. What does your like looking at the deal, like how much does the land matter when you're buying these notes, or if you have a buyer, like it doesn't matter. Or is it like you have a qualified buyer, it makes sense, or is it something like, okay, are you thinking about if they defaulted, what you would do with the land?
Exactly. So that's an extremely important consideration. I do look at the land very carefully. If it's a smaller lot and there's no perk test, that's going to be an issue for me because I don't want any huge surprises after I purchase the loan. So that is an issue on some deals. So I am not willing to purchase notes on any piece of land. I do look at the land very carefully, and it has to be something that I'm going to be comfortable with if I do get a default, going back out to market and being able to sell in a reasonably short amount of time.
That makes a lot of sense. And yeah, just not getting anything for sure.
Ever wondered how land investing can be the fastest path to financial freedom? I break it all down in my new book, One Lot at a Time. I'll show you exactly how to find, buy, and flip land for huge profits without dealing with houses, tenants, or any crazy renovations. It's simple. This is the book that I wish I had when I first started. If you're ready to take control of your financial future, grab a copy now. One Lot at a Time by Daniel Apke. Find it at your local bookstore or on Amazon.com.
What does your business look like in terms of your note business right now? How many notes are you holding? I think a lot of people are going to be like, okay, this is an interesting side of the business in terms of the note business. Like you're buying a ton of notes, you're providing, and there's so much value. Like this is your business, is having all these notes. People who follow us, a lot of people that follow us, like I want cash, and they want to sell notes to people like you. But what does your note business look like? How many notes can you hold? Like, are you trying? What does that look like though right now?
Um, it's large. There are a lot of notes. I couldn't even tell you how many there are. I mean, I don't manage them on a day-to-day basis.
Yeah.
That's done by a loan servicer. I just kind of look at the spreadsheets. It's a lot, but
Yeah.
there's always room for growth there. And it's my goal to keep buying more.
For sure. What's your background prior to 2017 in terms of like what were you doing to? You obviously understand the financing stuff. I assume you have a background in something like this before that.
Yeah, so I was a high school English teacher for 23 years,
Okay.
and I did fix and flip and buy and hold for 13 years, starting in 2002. I burned out on that. I discovered note investing, and I just loved that business. I mean, it was just so hard. I think I quit like 3 or 4 times. But once you learn it and learn the steps and learn the procedures, I really learned the business by buying non-performing junior lien residential mortgage loans, which was just kind of like a crazy niche. And I did that for many years. We would buy them in pools. And that's how I kind of learned the business was through the default side because you just learn so much about the individual state laws. And
Yeah.
then I discovered, that business kind of ended up ending because all the defaulted loans were sold off. And then I discovered land through a friend and I just thought, wow, this is just an amazing opportunity for seller finance.
So were you, as you were a high school teacher, were you doing land or were you doing these other things on the side, the fix and flip stuff?
Yeah, I was doing both. So I was
Okay.
doing fix and flip, buy and hold. I had like 30 rentals at one point. I ended up selling them all off, but that's a tough business. I would not want to have to do that again.
How'd you
The other
manage
thing is
that?
that I got married and I had
Yeah.
kids, and you can't really be like working on flip projects on the weekends and like managing contractors all the time when you have like a wife and kids. It became too overwhelming.
One thing I like about like your business, like very little of what I wrote down before in terms of like your note business, it's just grown. Like you know your lane in terms of like what you do, and like you don't really go outside of that. You just grow within that, which has been I think you've exploded in the last couple of years in terms of the amount of notes, your funding as well. But let's transition here, Eric, to funding because you do deal funding a little different structured than a lot of people, which is good. It's always good to have different options, everything like that. But first, let's just get into what have you seen over the last few years in terms of the funding space. And guys, we're transitioning away from seller financing right now. We're talking about you come to a funder, you come to a group of funders, whatever it is, and you're trying to get your deal funded. But what have you seen the last couple of years in terms of deal funding?
So I don't really do a lot of traditional JV funding. The majority of what I do is lending, commercial lending. So I provide loans, acquisition loans for land investors to purchase properties. It's a lot lower cost of capital than the JV funding split. Um, I'm seeing a lot of subdividing going on, which really works well for the debt space. The other thing that I'm seeing that's interesting is that um, the really the 50% of value acquisition in hot markets that are selling very quickly, those are becoming more and more of a unicorn. And in those situations, I'm seeing people buying at 65 cents on the dollar, 70 cents, maybe even 75 cents on the dollar. If they know the market, they know it's going to sell quickly, and they're still really making a lot of money doing that. Um, so that's kind of an interesting dynamic that I'm seeing in the space. But I speak to a lot of land investors on pretty much a daily basis,
Yeah.
and so I see a lot of dynamics, and then I have my internal data that I have on all of the loans that I've done.
So JVing guys to define that is going to be like, okay, you come to a deal funder and you guys are splitting profit on a deal or something like that. Eric's talking where you have interest payments, stuff that is a little, probably it's riskier for definitely the investor. So I assume you work more so with more experienced investors, not only for your good because you have a better chance of getting paid out, everything like that at the end of the day, but also for their good, where like maybe it's the best thing for them to work with the JV partner their first 3, 5 deals before they try to maybe lock down and get a little bit cheaper money that is a little more risky if you just look at it by the books.
Yeah, so in my experience, when people first start out, they really need the funder because the funder's not only going to fund 100% of the deal, but they're also going to give them guidance on best practices and getting the property sold quickly. Um, Typically, what happens is as their businesses grow, they look for a much cheaper cost of capital and source of capital in terms of like being able to call somebody up or send him an email and have a commitment for a loan within 24 hours. So that's really the type of investor that I work with, somebody who's looking for fast, easy capital and the property in their name and having full control and a lower cost of capital than the JV split.
And there's not many people like you in land. Like all the people like you are in fix and flips or house flipping, and they're giving. But as far as like people who understand the land business, giving debt opposed to giving the JVing, like there's not many people. Like I don't know if there are any other people that are doing just like you. That it's like this is your business model in terms of the funding aspect. Have you seen anything else like it, or terms of I guess what made you kind of stay in land and do this for land instead of other things? It's just your expertise that you've grown.
It took me a long, long time to learn land. I still am not an expert. I have two analysts who I work with on all of the deals that I finance, and they're much more experienced and savvy than I am. The difficult part about lending is that you have to know all of the compliance laws on the federal and state level because there's federal laws that you have to follow, but then there's individual state laws. They're all completely different. And the compliance for these loans can be kind of overwhelming at times. Um, it's a very different business than JV funding, which really isn't regulated anyway. You sign the contract, you're working together, and you can get started. Whereas as soon as you kind of use that term interest, you are governed by a lot, endless laws and regulations that you need to be aware of, because if you're not following those, you can get in big trouble because state regulators are watching what's going on and they kind of assume that lenders have deep pockets and they just love to fine them if they are working unlicensed or not following the guidelines and regulations in compliance.
So they come for the lenders and not come for like are land investors getting hunted down as well if the lender's not complying with the whatever state federal codes?
No, no, it's 100% on the lender. If you're originating loans to a
Yeah.
borrower, you are 100% responsible. They don't really look at the borrower in those situations. They expect the lender to know all the rules and laws.
That's interesting. What are the what kind of compliance is it? Is like making sure they're not taking advantage of people. What does that kind of look like in terms of the compliance? I'm sure there's a lot in different states. I'm sure some states have it absolutely crazy in terms of the compliance documents. Some are probably a lot shorter. What does that look like from state to state, or some of the most outrageous ones you've heard?
So it's different in every state. The first layer is licensure. There's many states in which you have to have a license to do any type of lending, even commercial lending. Every state you have to be licensed if you are doing consumer lending. Commercial lending is different. I'm not an attorney and I don't want to be passing on like legal advice here. For that, you would need to consult a banking attorney, and those
Mhm.
guys charge like $1,000 an hour. But really all I can say is that there's issues of usury. There's issues of maximums that you can charge. There's issues of federal compliance regarding closings and what needs to be provided at closings. So it is, a relatively complicated field.
That makes sense. You said a little bit ago, like you're seeing purchase prices go up relative. Is this again, I think we talked about before we hit the record button, you're seeing that a lot, especially in faster markets, like purchase prices buying at 50% of market value is getting tougher.
Yeah, I actually get a lot of deals in my finance business that are rejected from funders because they weren't purchased cheaply enough. Like they're being purchased 70 cents on the dollar. There's still a great margin there if it's going to sell quickly. It's not a good fit for a funder, but it's a great fit for me because I'm not really looking at the profit because I'm not linked to the profit. I'm just looking at the loan to value ratios.
So is that so they should be if they're trying to do that as far as buying and we suggest the same thing. If you're in a faster market, like you can definitely push it because your ROI, like irregardless of a fund or a bank, whatever that's happening, irregardless, like if you are moving a deal, buying for 70 cents on the dollar and moving it in a week versus buying for 50 cents on the dollar and moving in a year, like your return on that first option is much, much better because how fast you're turning your money. And I guess that's when it makes sense for you. Does that tighten up like your analysis of a deal though? When like, okay, we're getting a little closer to, you don't want to put an investor in over their head at the same time, even though you're collecting interest, stuff like that. But I'm sure that makes it a little more tighter in terms of you reviewing the deal. Is that accurate?
Yeah, absolutely. My main metric is loan to value. So what am I lending versus what is the property worth? Another interesting thing that I've noticed is that as I've been doing this, the realtor opinions on the properties are by far and away the most rosiest.
Yeah,
So
100%.
I used to require a realtor opinion and then I dropped that just because, there were so many cases in which the realtor opinion was so far off what the data was showing. So I look at that, but I don't really look at it as carefully as I used to. I rely more on my internal analysts.
Yeah. That's a really good point. And what I do with realtors, or what we always suggest with realtors, is like, first, you got to come up with your own opinion. Like, come up with your opinion. Maybe you get a second set of eyes from the community, something like that. And then after you already have, like, I feel good about this property, it feels very much 50 to 60,000 comps are showing that. Then you have a realtor come back, or two realtors come back, say $85,000 for the sale price. You need to push back on them. I think that's the biggest thing that I tell our students to do is when they get realtor opinions that they don't think are accurate, they're experts too. The realtors know the area, everything like that, but pushing back on them, like, okay, you're saying $85,000. Here's a comp that's very similar down the road that just sold for 55. I literally will ask them, like, how are we going to get 30,000 more than this property? Like, what was wrong with this property? And a lot of times they kind of fumble with their words with that stuff for sure.
Yeah. Um, yeah, it's been interesting. That's really one of the reasons that I think that this space isn't more popular. It's just because there's just not as much valuation data out there, and the valuation is definitely an art. Um, and I still struggle with it. I mean, there's like three of us putting our brains together. We might be way off on what our opinions are. So.
It takes time. It takes time. And like, still, like when you go into one of those markets without a lot of data, you're like, I don't know what the heck's going on here. Like I have a comp from 2022, like that looks okay, but I would assume the market did something since 2022. And like, that's legitimately in land. And it's also 7 miles away. So like sometimes your best comp is a really bad comp. If you're comparing to house comps, everything, like you can get a neighborhood comp 99% of the time. In suburban America versus these, like it's an art, and that's a good point. And you said you have three people, you and two analysts. Is that their full-time job, just like analyzing deals that are coming through?
No. So they are just paid on a per deal basis. They are both highly experienced land investors. It's really not something that you could bring in a VA for and train them. I just wouldn't feel comfortable with those opinions. So these are seasoned veterans who do this for me on the side.
Got it. That makes sense. So let's wrap it up with like, what do you think the future of this business is in terms of land? Just curious, your insights. You obviously are doing a lot of deals. What do you think the future of the business is, though?
I think it's an amazing business. It is still an amazing business. One thing that I am seeing is that some people are leaving because the industry is changing. It's becoming a little more challenging, but I still think that there is just endless potential in so many markets in so many ways. I think it will continue to be a great business moving forward. I just don't see like private equity or Wall Street moving into this space just because there are so many significant barriers to doing this on a large scale. So I just think it's I've done a lot of things in real estate, and this is probably among the top two best that I've done.
Yeah, it's cool the people that can be successful and the people that are falling off, and we see it. I mean, I think regularly you see people fall off. It's the people that are trying to do the business the same way they've done the business since 2020 or something. They were making, maybe working this as a side job, making $200,000 a year, and just kind of, and then their reasoning is like the business died off. Like, no, your strategies didn't evolve. Like, and I think that's the biggest thing in any industry is evolving your strategies. I'm sure, like I said, your funding hasn't changed that much over the last couple of years, and you have your plan, everything like that. But as far as with land investors, and I'm sure like the most successful people you work with, like they're doing some pretty diverse things and kind of adjusting their business. I'm sure, I don't know how much you know about their individual businesses, but being able to adjust is really, really important.
So probably, you don't know this, but probably the number one best investor that I work with, the guy that I have the most respect for, this guy is just unbelievable, came up through your program.
It's good to hear.
I'll tell you his name later.
Awesome. No, that's good to hear. I'm glad.
He's just an absolute monster in the industry. But there are so many people who are flying under the radar and just absolutely crushing it in this business who you don't even know are out there because they're not posting on social media. They're not training. They don't have a program. They are doing the business day in and day out. And just the deals that I see them do, they're really remarkable. It's an interesting perspective for me because I've never run a land business. I never will run a land business, but I see people really doing amazing things.
You're running a land business, just a different type of
Oh,
land.
yeah.
Yeah, that's a good point because I mean, I have been reach out to so many of our students and just like ask like, you make sure they're doing something, but the amount of people that are just doing this business at a high level, and I haven't heard a damn thing from them on Discord or anything. And like I would guess like, okay, they're just sitting on their hands not doing anything. Then they come on the podcast. I had one person come on the podcast. He's like, yeah, I did 30 deals in the last year, in my first year. He's like, is that a good thing? I'm like, yeah, that's pretty good for your first year flipping 30 land deals, and you made a few $100,000, $400,000 or something. Like, you're killing it. So many people that are under the radar in terms of doing that. Anything else you wanted to add, Eric, that we missed before we get off here?
I would encourage you to reach out to me, regardless of the business that you're running, the size of the business that you're running. I'm really confident that I have a program that can help you improve your business. So feel free to email me or call me, and I really do feel like I can provide a unique program that really can help you expand your business and make it more profitable.
Are you in our Discord server, Eric?
I am, yeah.
Okay. In our Discord server, everything like that. Awesome. And like at minimum, guys, if you have land sitting on the market, offer that. Those first 10 minutes of this episode were absolute gold in terms of like how to offer that seller financing, and you can cash out on it. It is not holding a note. We're not asking you to hold a note for 10 years. Eric will buy your note if it's good land, if you have a qualified buyer. So I think at minimum, guys, if you're doing this business, flipping deals, you have deals sitting on the market, at minimum, you guys should be offering that. Maybe you don't want to do it the first 2 weeks or 3 weeks you have it on the market, and you're like, crap, I can't sell this. Then have that as an option. I would do it out of the gate, to be honest, and just up that 10, 15% over asking price and go from there. But Eric, I really appreciate you coming on, guys. If you are watching on YouTube, hit the subscribe button below. If you're listening on Apple or Spotify, share this with a friend. Thank you so much. We'll see you next time.
Thanks, Ron.